Good morning. It's Jeffrey Christian, CPM Group. It's about 10:25 on the morning of Friday, the 16th of June here in New York. Gold's trading around $1,978. Silver's around 24.25 right now. Platinum's a little bit low, below 1,000 at 995, and Palladium is a little bit below 1,400 at like 1398. I wanted to talk about the state of the markets a little bit and our expectations for the prices in the short term, the short term, and the intermediate term, and the long term. CPM Group issues trade recommendations. This is the top of one of our gold recommendations. There's a lot more text, and then there's 1 month range of prices and a 3-month range of prices at the bottom of it. And then we have these for gold, silver, platinum, and palladium. Yesterday, we issued new trade recommendations for all four metals. And basically, we were on the sell side on the short term. These are trade recommendations for the next 5 or 10 trading days. We have what we consider short-term recommendations, which are like the next 3 months or the next year. Intermediate term projections, which are the next 1 to 3 years, and long-term projections, which are the next 10 years, or in the case of platinum and palladium, we're taking the projections out to 2050. So that's, I guess, 27 years right now because of the long effects of the energy transition on precious metal, on platinum group metals use in auto catalysts. We don't think that just 10 years worth of projections really gives a long-term investor looking at platinum group metals the insights that they need, given the complexities and the slowness that we expect to be experienced in the energy transition. So we released 4 trade recommendations yesterday, and they're subscription basis type of things. With gold prices, what we were saying, with all of them, what we were saying was, given the state of the economic environment, yesterday, I guess on Wednesday, the Fed issued a FOMC notice, and they said that they were not raising interest rates for the first time since March of 2022, and they might raise interest rates 1 or 2 more times later in the year, because A, the economy is stronger than they and others had expected, and B, inflation is dissipating at a much slower pace. And again, the problem with inflation is that inflation is really a composite of price changes. And if you look at the individual segments of the economy, what you find are some of the inflationary pressures that we experienced in 2021 into 2023 have been short-term cyclical type of things. Some of them were short-term issues related to coming out of the 2020 lockdown, and some of them are long-term secular changes that really are semi-permanent and will be much harder to deal with. So you have, for example, in the energy market, if you look at the CPI and other indicators for May, you saw energy prices, specifically petroleum products, gas, and diesel and heating oil, coming down very sharply, reducing overall inflation. But food prices continue to rise at like an 8 to 9% rate, pushing inflation up. And then if you went into the non-energy and food sectors, you'd see that, transportation and housing were still up, but other things like medical services were down. Used car sales, which were a major factor in 2021's inflation increase, continuing to decline and stuff like that. So the Fed issued we're going to stand down now, but we're still going to be very aggressive, perhaps more aggressive than the markets would like to see, in fighting inflation in the second half of this year. Then on Thursday, the ECB increased its interest rates because it has more inflationary problems than the U.S. has. China, the People's Bank of China, actually reduced its headline interest rates earlier in the week because it's continuing to have a weaker economy than it would like to see. So you have a real mixed picture. What that means, in our view, for gold prices is that, and that's just monetary policy. I'm not even going into fiscal policy or the overall real economy in terms of supply and demand for goods and services, which are really the factors that move inflation, as I've spoken about in the past. Put that all together, and what we see in the gold prices, the possibility of a further spike down in the very short term, the next week or two, simply because the prices have been testing 1950, and it we think that it could break below that and possibly move down toward 1920. And then we wouldn't be surprised to see a bounce back simply on a short-term recovery after a sharper decline. And then our expectation is that the prices remain weak through the third quarter, July, August, into September probably, and then start rising much more significantly in the fourth quarter. So when we put out a trade recommendation, we try to capture the nuances of CPM Group's data, research, analysis, and the nuances that occur within a specific time frame and across time frames. Short term, we're bearish. Short term, we're not necessarily bearish. We just think the price is not going to rise in the next 3 months significantly. Longer term or intermediate term, we're very bullish in that we think that the price will start rising in the fourth quarter and will rise at an accelerated pace in 2024, maybe 2025. And then on a 10-year basis, we think that that spike up in prices when it occurs, 2024, 2025, whenever, would be short-lived as they tend to be and come back off. We changed the time horizon on the charts that we're using here. This is just since January 2022. And, in Tuesday's video, I think the title of the PowerPoint was Gold and Silver Treading Water. And you can see they sort of have been treading water. We moved up to a record high in early March of 2022 after the Russians invaded Ukraine. The price came back down into early November. It started to rise. It got higher. It moved back into higher levels by the middle of May. And since the middle of May, it's been coming down. And that's sort of the pattern we expect for gold and for silver. Very similar pattern. If you look at the fundamentals of gold, you're seeing weaker demand in the People's Republic of China. You're seeing weaker demand in India. Those are the two biggest markets for gold bullion and for gold jewelry. You're also seeing weakness in Europe and North America as some of the investors pull back from the recession fears that they had earlier in the year. And they're taking a more cautious wait-and-see approach toward all of the economic and political problems that are clearly on the horizon, are clearly not being dealt with effectively, and will come back to haunt us, but possibly not in the remainder of June, July, and August. So we're seeing some weakness in investment demand, and that's the key driver for gold prices. We're also seeing some backpedaling by the gold promoters. And we're seeing in April, we saw a very weak net investment demand or stock demand for gold bullion by central banks. You had two central banks that were recently large buyers, Turkey and Kazakhstan, large sellers in April because they needed the foreign exchange to pay for their imports of various goods that they were importing. And that offset demand from China and several other central banks. So you basically have seen in the first 4 months of this year about net purchases of 2 million ounces. That's at variance from what some of the promoters will tell you. And if you go back to the China, last year we saw the People's Bank of China accumulate a lot of gold that people were asking it to sell. And some people misinterpreted that as being central bank purchases for monetary reserve purposes. It wasn't. In November and December of last year, the People's Bank of China started buying some of that gold out of these market inventories and adding them to monetary reserves. A couple million ounces in the last 2 months of the year. Those are the first purchases since the first half of 2019, when the gold price moved above 1,350 in the middle of 2019. The People's Bank of China pulled back from buying gold for monetary reserve purposes. In the first 4 months of this year, they've continued to buy some of that gold and add it to their monetary reserves. They did again in May, from what we can tell. And it was partly because of weak demand for physical gold within the private Chinese market that gold was starting to build up in the side pocket again, the trading inventories. So the People's Bank of China bought a little bit more and added to it because they see this as a cyclical decline in the gold price due to weak demand, seasonality, slightly better economic conditions, and other factors. Silver, I'm sorry I didn't change the title. It says gold prices, but the chart says silver prices. Silver prices a very similar pattern, although somewhat weaker than gold. Again, we saw the price spike higher in early 2022, come back down. It rose in the fourth quarter of last year, giving it a very good performance on a year-over-year basis compared to other assets. It treaded water in January and February, January came down in February, went back up in March, and it's been drifting lower over the last several weeks. Our expectation is very similar to what we have for gold, which is that the price could come off in the short term. Could be a little bit of a short-term rebound after that. We think that the price stays relatively low over the next 2 or 3 months and starts to rise in the fourth quarter into 2024. So that's our expectation there. I did manage to change the title on this slide to platinum prices. These are platinum prices. And again, treading water, but for different reasons. Gold and silver are financial assets as well as commodities. Platinum and palladium are commodities with a little bit of a financial aspect to it. And whereas gold and silver prices are primarily determined by investment demand trends, platinum and palladium prices tend to be determined more by auto industry demand than investment. Investment demand can have a high-powered effect on platinum prices, good and bad, palladium prices too. But it's really the auto demand. And if you look at investment demand, where gold and silver investment demand are primarily determined by investor expectations of macroeconomic, financial, and political factors, in the platinum and palladium market, a lot of the investment demand is determined by investor expectations for platinum and palladium demand in the auto industry. Auto industry continues to suffer on a global basis. There are pockets of strength. There are pockets of weakness. In addition to some cyclical trends, you have some secular trends, including people buying fewer cars in industrialized nations and the growing purchase of electric vehicles, which don't use platinum, palladium, and rhodium in their catalysts to clean up the exhaust from gasoline or diesel fuel. So you've lost about 10, 12% of the light-duty vehicle market on a global basis in the last few years. And that has reduced demand for platinum group metals in autos, and it has also reduced investor interest because the investors see this happening and say, okay, the world's going to need less platinum than otherwise might have been expected. Platinum has an advantage in that within the auto catalyst market, you're seeing increased use of platinum as fabricators shift away from using palladium intense catalysts to using more platinum intense catalysts, palladium and rhodium. The shift is really palladium and rhodium insofar as you can shift away from rhodium to platinum. So platinum has a little bit of a tailwind in auto demand because of the substitution within it, but it's gaining market share in a declining, in a contracting market. So it has a little bit of a problem there. Our expectation is that the price continues to tread water. We saw in the period, say 2015 to 2020, 2021, the platinum price was trading between 800 and 1,000. It has been trying to break above that, and our expectation is that it will in the long run, but not in the third quarter of this year. Our expectation is the price, it's trading below $1,000 right now, and it has the scope to fall to 950, and quite frankly, it could go all the way back down to 900, which is where it was in late February, early March. That's the short-term view. Longer-term view, we do think that platinum prices will dust themselves off and move higher. If the world or the U.S. or the industrialized world, the U.S., Japan, and parts of Europe move into a recession, 2024, 2025, that could reduce auto production and sales, which could limit platinum's upward price and delay the time when you see the price rise. But we're modestly bullish on platinum prices, and then we're modestly bearish on palladium prices. Palladium prices got very high, which is one of the reasons why you saw a substitution away from palladium to platinum. If you go back to the platinum price, you can see here in early 2022, the price was spiked up to 1,200, but it was mostly around 1,100. You look at the palladium price, and it was mostly around 2,300, and it spiked up to $3,370. So in other words, you had palladium prices twice as high or more than twice as high as platinum prices, which is one of the reasons why you saw that substitution. As with platinum, you have the headwinds on palladium prices of auto sector, the auto industry's secular and cyclical weaknesses. And then you also have the added headwind of losing market share as auto manufacturers shift where they can away from palladium to platinum in their auto catalysts. As a result, we don't necessarily see the palladium price rising. And our short-term view is that, yes, the price could fall further. And our intermediate-term view is that the price could stay low and move even lower. That's what we have in terms of our views of the state of play of the four major precious metals. Next Tuesday, we will do another public video. I had said in Tuesday's video that I thought we might not, but my colleagues assured me that we will. And then on Wednesday, we have CPM Group's question and answers for clients. So if you are a client of CPM Group, you can plug into a live open forum on Wednesday, 21st of June, 11 a.m. We won't be trying to balance raw eggs. It's the solstice. But I guess you balance the eggs at the equinox, not at the solstice. I'm sorry. It is the solstice. We probably won't wear druid robes for this, but we will have an open Q&A session. Could last an hour, could go longer than an hour, depending on how many questions we have. And it's a chance for clients, including retail investment product clients, or people who have bought our yearbooks, to ask questions and follow up on the comments that we've made, either in our reports or in these videos. That's all I have for now. Have a good weekend. Take care of yourself. Take care of people around you. Take care of the world insofar as you can. We'll talk to you next week.